Hey there, Vinny from Project Frugal. In this video, we're going to look at income splitting. If you're part of a couple, I'm going to show you how to save thousands of dollars, potentially anyway. I'm not a financial advisor and this is not financial advice. This is purely for entertainment and educational purposes. So without further ado, let's get into it. The first thing we need to figure out is what exactly is income splitting. The Wikipedia definition of income splitting is a tax policy of fictionally attributing earned and passive income of one spouse or to the other spouse for the purposes of assessing personal income tax, i.e. splitting away the income of the greater earner, reducing his or her income for tax measurement purposes, thus reducing tax rates paid by the spouse who earns more and increasing rates paid by a spouse who earns less or nothing. So what does that word salad actually mean? Well, it's basically you've got two incomes, your income, your partner's income, and it's pretty much about minimizing the tax that you're going to have to pay. Simple as that. The majority of countries offer individual tax assessments, but in some cases there can be joint, husband and wife, for example, joint tax assessments. Unfortunately, these are only done in a handful of countries, including the US, Canada, Germany, and a handful of European nations. Income splitting was proposed in New Zealand back in 2011 by Peter Dunn, the then Minister of Finance. However, this never got past the first reading in Parliament and was subsequently discarded. So this method can't be done through joint tax filing in New Zealand. However, it can be achieved in a pseudo manner by careful planning. We're going to examine three main timelines in life and see how you can legally apply income splitting to your circumstances to save you potentially thousands of dollars. And here we go straight into the numbers here. We've got a bunch of scenarios that I've already mapped out. Yeah, we're going to save you some money, I can pretty much guarantee it. Down the track at least anyway. So the current tax rates, if you're earning up to $14,000, you pay, well, it's 10.5%. 14,000 to 48, you pay 17.5. Over 48,000 up to 70,000, you pay 30% tax. Over 70,000 up to 180,000, you pay 33% tax on that number. Any remaining income over 180,000 is taxed at 39%. That's under the current rules. Now, New Zealand offers a progressive tax system, so pretty much the more you earn, the more tax you pay. However, the new government has decided to change the tax bands. The 14,000, what was previously 14,000, is now going up to 15,600 for the threshold for the 10.5%. If you earned 15,600, that extra $1,600 would be taxed at 10.5% instead of 17.5%. You're not going to save a lot of money out of that, probably $70 or $80, something like that, maybe a bit more. So if we have a look at this, we've got some numbers here. We're going to go with Vinny and Denise for this scenario. Now, it doesn't matter who makes the income in these scenarios. If you're a single person and you're filing your tax individually, it's pretty much going to make no difference whatsoever because you're not going to be splitting your income with anyone. But this is really designed for couples, and in the scenario, it doesn't matter who the breadwinner is. We're going with Vinny at this stage on the left, Denise on the right. If we chuck in here, if we chuck in $15,600 and we hit enter, let's see what happens. So we've got a total income before tax $15,600. Tax paid based on the tax rates as of the 31st of July 2024. So in the hand, you should be getting $13,962 after tax. And your effective tax rate would be 10.5%, as we've seen in the scenario here. If we bump this up just by a little bit, just to make sure it's working, let's say $20,000, you can see the effective tax rate is now 12.04%. So the majority of the money is taxed at 10.5%. But the final $4,400 is taxed at the higher rate of 17.5%. And that's how we come up with this number here. On a $20,000 single income, you would expect to have $17,592 in the hand after tax. Now, the real change of this really comes in when you're adding two different incomes. So if we was to say Denise also earned $20,000, we'll chuck those numbers in there. You can see we've got the calculations. Both parties are paying the equal amount of tax, $2,408. Both parties are getting the same net income. That's all well and dandy. That's fine. Now, the big thing here is if you've got uneven incomes. This is where income splitting really takes effect. If we move down to scenario one, in this case, Vinny is on $50,000 a year before tax. Denise is not earning any money. The simple thing here is the net income is $42,342 or $814.27 a week. The effective tax rate is 15.32%. We can verify this. Chuck in the 50,000 over here, move over to here, chuck in 0 over there, and voila, yes, the numbers match up. Now, where things change a bit, let's say we've got some investments, and in this case, what have we got here? We've got 25,000. Well, let's say maybe all of this money is not actually wages, but it's all investments. Well, maybe Vinny gets $25,000 for working, and maybe Denise is the investor in this scenario, so maybe she's not working, but she's got a $25,000 income because of investments. Well, that could be practical. If we split the incomes, I've still got to do my tax return. Denise has still got to do her tax return. But in both scenarios, we're saying we earn $25,000. Based on those numbers here, we have now got a total tax bill of, we've got an income of $835.27. So the same income as $50,000, except we're splitting it over two people. Because in this scenario, one earner is earning $25,000, the other's earning $25,000. So it's not quite as straightforward. But we would be $21 better off a week. And that's at the end of the financial year when you do your taxes. When you work it all out, you'd be just over $1,000, almost $1,100 better off in that particular scenario. If we had a look at another scenario here, we've got a total household income of $100,000 for one person. And in this scenario, we're saying Vinny makes that much money. Okay, that's cool. There's the numbers there, $1,483.13 in the hand. We're not including any KiwiSaver, any working for families, anything that's going to muddy the mix. We're just going off the basic raw numbers. And then scenario 4, if we're saying, well, both parties actually earn $50,000 each. Now that $50,000, as I've said before, that could be investment income. It could be wages. But if we were to split that money somehow, now we can't do it legally via the IRD because the bill was never passed, but this is really about if you've got investment income. This is where the beauty of income splitting really comes into play. I might make the money, but Denise might be the investor, as it were. So if she's the investor and that's her only source of income, that essentially is her income, and my wages are my income. If I was to be the wage earner and the investor, all the money is going to get taxed at a higher rate on my total investments and total income. So in this scenario, if there was a $100,000 income, we could say that this income was derived from $50,000 worth of wages and also $50,000 of investment income. We can chuck the numbers up here. Scenario 3, $100,000, but we're saying Vinny gets $50,000 worth of wages, but he's also got a $50,000 income for investments. And this could be dividend income. This could be, maybe it could be rent. Who knows? Could be anything. We've got a other income box there, but we're not going to actually sort of use that at this stage. Anyway, $100,000. Yeah, you got the numbers down here. And this time we're going to give Denise the $50,000. You can see here the net income for the total, $1,483. If we give Denise the $50,000 worth of investment income in this scenario, we're taking it off Vinny. It's all under Denise's name. She's earning exactly the same amount per year, except she's not working for wages. She's working purely off investment income, dividend income, rental income, whatever that income is. In that scenario, $1,628.54. So, $1,628.54. So versus the $100,000, which was derived from wages and investment income in scenario 3, we've actually made $145.42 a week better off just by splitting that money. Instead of having all the money in one name, we've split it into two names. Vinny's the wage earner in the scenario. Denise is the investor income earner in the other scenario. As you can see, we haven't increased the income at all. Vinny's on $50,000 a year. Denise is making $50,000 from the investments. We've just split where that money goes to. Both parties are still putting in their tax returns, but they're getting taxed on the $50,000, and the $50,000 is all corresponding to the new tax rates here. So everything's getting taxed at 10.5 or 17.5% in this scenario because both parties are not breaching the $53,500 tax threshold to go on to the next highest bracket. Moving on to scenario 5, we're now saying that Vinny has got a $100,000 salary and $50,000 investment income, and the same deal applies. Denise might not be working. She might be a stay-at-home mum, something like that. Maybe she volunteers. We're saying in this scenario, this is the amount of net income. We're paying almost $40,000 a year in tax. if we were to put the $50,000 of investment income, because that's what we had in scenario 5, give it all to Denise, we're now $170.04 a week as a couple better off. So that's $8,842 a year. Now, if you can make $100,000, you've got $50,000 worth of investment assets coming in. Whew, you are onto a winner, that's for sure. And the other assumptions that we're going with here, $625,000 worth of assets. In this case, we're going to call them stock market investments, paying out dividends of roughly 4%. We're not including the tax in this. That would actually give you $25,000 worth of income per year if you just held on to those stocks. If you had 1.25 million, that's a lot of money in anyone's books. You should be able to get $50,000 worth of income from those assets there. Pretty much the more money you can actually make and invest and then split the income, the better off you're going to be and the more this actually works. And that's one of the reasons why the government pretty much rejected it in the first place, because it certainly does benefit the rich. It does nothing for the poor. If you're too poor and you're in those lower income brackets, well, it doesn't mean anything really, because it's not going to have any impact on the amount of tax that you have to pay and the amount of tax that you can potentially save. So now we'll go and have a look at retirement income, because things definitely change when we get to retirement. If we look at a couple's income in retirement at the moment, it's paying, how much is it paying? $23,993. That's in the next tax year, I believe. That's before tax. If we looked at a couple and that's all they had no investment income, they would each earn $20,886 after tax. So that's $41,772. They'd get $803 a week. That's not too bad. And the effective tax rate, because some of it does go over this 10.5%, would be 12.95. So most of the money is, you got up to the 15,600 is getting taxed at 10.5%. Anything over and above that, which in this case is, how much is that? Oh, that's a tough calculation. There's 7,000 and a bit more, getting taxed at 17.5%. In this scenario, we're looking at scenario 1. This time we've got a investment income of $25,000 per year. And that's pretty much the investment income that me and Denise are going for on Lean Fire. But we will split that income regardless. So we'd say she's got half of the assets, I've got the other half of the stock assets in this case. If we can make $12,500, will that give us any benefit? Including, we're presuming in this scenario that we're both on the superannuation, we're both at 65. The government doesn't means test the superannuation. We're getting $12,500 each from income, dividend investments or dividend assets or dividend payouts for stocks, probably New Zealand stocks I might add. Well, in this scenario, we've done that. We've crunched the numbers here. We can chuck it in here. We can go 30. We can go 23,993, and we've got $25,000 worth of investments. That's half each. We can also chuck it over here. We can see here we're earning $31,199 each, because we're still filing our tax returns individually, and our effective tax rate is 14.51%. So that's cool. But what would happen if we were to just chuck it all into Vinny's name? What would happen there? Well, let's try that in scenario 2. We'll chuck 25,000 on here, so it's all under Vinny's name at this stage. Okay, so the net income here is more, because Vinny's income in this scenario is still below the $53,500, but above the $15,600. There's no more tax to pay, and the effective tax rate is still the same, because there's no benefit, because the additional money that both parties would have had by splitting this money is still taxed at 17.5%, because it's above the $15,600. Moving on to scenario 3, we've actually got some more money in this occasion. We've now got $50,000. We can see here that we've split the money into both parties, so we've still got the $23,000. We've got $25,000 here. We got $25,000 over here. Both parties are earning $41,511, earning between them almost $1,600 a week. Now, why is that scenario better than if Vinny maintained all the assets? If we chucked all the $50,000 worth of investment dividend income into Vinny's, under Vinny's name, shall we say, and Denise had none of it, or vice versa, then Vinny is earning $59,595 after tax, which you can see down here. And Denise is still only earning $20,886. Combining those two numbers there, we're getting $1,547.33 income. But if we were to split that money, yeah, the scenario changes completely, doesn't it? Because we are actually $49.25 better off. To cut a long story short, the more money that you can earn, the better off you are to split it as evenly as possible. Because of these thresholds, the less money that you actually pay. And the third scenario is if one person is retired, but the other person is not ready to retire just yet. Maybe they have a job, maybe they don't have a job, but their income, yeah, it's going to be the retirement, whatever that might be. So if one party was earning 100,000 and you pretty much know the next party is retiring and now they're on $23,993, if you can boost their income up for the investment assets or any real estate or anything else that you might have that they're still going to have to pay tax on, try and get it up to the 100,000. Yeah, likely story. It's probably not going to happen, but that's the ideal goal, because that way both parties will still get the benefit of the lower tax brackets, pushing that money up, and eventually they'll, yeah, pretty much save as much money as possible. It's not the easiest concept to explain in the world, but you can see sort of how it works based on these numbers. If you do want the spreadsheet, let me know and I'll see what I can do. Now, if you're on a low income, you've got low amount of assets or a low amount of dividend earning income, it's pretty much not going to make too much difference. When you have a wage disparity between two parties and you've got additional income in the mix, there certainly is definitely ways that you can, yeah, pay less tax pretty much. And there we have it. We've shown you all the scenarios. Hopefully you apply some of these scenarios to your situation, give you at least some food for thought about what to do in the future. Hopefully you can save hundreds, if not thousands of dollars by applying some of these methods. If you got some value out of this video, hit the like button, hit the subscribe button if you haven't already subscribed. Leave a comment down below. We'll catch you in the next one. Have a good one. See you later.